Got it. Got it. Got it. Okay. Okay. So this is a call with Chris Pierce over at BOK, and we're going to be spending some time doing some underwriting and discussion on, the senior housing, assisted living facilities and how they size them up, how they assess them, so we can get a pretty good sense for what to look for, where are some of the risks, how do they underwrite these things, what are they going to need to collect, and then what's the process to get to the finish line. So we're going to spend some time. So Chris, thanks for taking the time today. Appreciate it. So Chris, tell, I guess maybe start off with, when you're looking at, I guess what are sort of some of the broad categories for the different types of facilities that you're looking at?
Yeah, so senior housing and skilled nursing are kind of the two legs of aging in place or aging care facilities. So in senior housing, that typically includes independent living, where there's little to no care, assisted living, where there's some needed care from nurses and just ongoing monitoring almost. And then you have memory care, which is on the higher end of acuity, where it's 24/7 nursing care. And that's the step typically before skilled nursing, which is, they're no longer ambulatory. They're just kind of stuck in a bed. That's where you'll see a lot of Medicare and Medicaid reimbursement. And so those are kind of the four, I would say, main segments. Typically in senior housing, you will see CCRCs, which is the full continuum. So you have independent living through skilled nursing on one campus. Those oftentimes are not for profit. So I haven't spent a ton of time in that segment. It's maybe like a bond financing kind of industry. And then you have operators who focus primarily on senior housing, so independent living, assisted living, memory care. And then you have operators that focus on skilled nursing. They're very different. The lingo is different. The kind of debt packages and covenants look very different, but they're oftentimes kind of thrown in the same umbrella of senior housing. So those are, I would say, the four main. I've spent most of my time in for-profit skilled nursing, but worked on quite a few assisted living, memory care. BOK has a much better track record the higher you go up the acuity scale. So the more dependent on a facility's performance that's based on healthcare that's provided, we have a better track record and success rate. There's other banks that do a really good job on the opposite side, where it's more of a commercial real estate play, right? So that's mainly independent and assisted living, but has less memory care and seldom or no skilled nursing.
It's really good. So what are some of the, you kind of mentioned, hey, these really are two different worlds, two different debt packages. What are some of those major distinctions that delineate them? Obviously the business model is, but what is it that stands out to you?
It all starts with level of care. So skilled nursing, the amount of nursing care expense, the margin is pretty thin, but the volume or the revenue, right, from Medicare and Medicaid is high. So those operators tend to make their money based off of watching their skilled mix. It's much more complicated than senior housing because you have government reimbursement risk. There's different every state handles Medicaid differently. So it can get pretty complicated on understanding what we call per patient day revenue, right? How much are they getting paid per day that they're providing healthcare services to their residents? So that's one thing for skilled nursing. The other in senior housing is more of kind of what you'll see on a rent roll. There's level of care, but it's not ongoing daily census where you're getting billed, 100 days of Medicare, and then it converts to Medicaid. And there's just all these different complicating factors for skilled nursing versus senior housing or assisted living memory care. As far as like lending goes, the lingo that really changes is you'll see in skilled nursing, they use EBITDAR as kind of the numerator or what we're sizing deals with. In senior housing, it's NOI. There's some overlap there's certain adjustments that are made on both calculations, but from a conversational point, if you're really working with an assisted living or memory care or independent living operator, you're going to hear NOI. If you're with skilled nursing, it's EBITDAR or EBITDA, depending if it's lease fee or not. But So and then same thing on the leverage side. So you'll see a funded debt to EBITDA on skilled nursing, and you'll see a debt yield. So the inverse of that in the senior housing. So I think senior housing, I've never worked in commercial real estate, like true commercial real estate. It definitely falls kind of more toward that dialogue and even personalities with people who are kind of finding deals and putting financing packages together for senior housing. It feels much more commercial real estate, where it's based on the value of the property, where skilled nursing is much more on the operations, right? There's a big air ball. There's, or not air ball, but there's just the business value is based off of that EBITDA, right? Yeah. Yeah.
Okay, so you're basically over here on the assisted living or independent side. You're basically dealing with almost a quasi apartment with a lot of real estate and some sort of layout. There's less intrinsic value on the business element of it.
Correct.
Over here, you're very high on that, going concern value, airball,
Yes.
sort of element, a little bit, significant less on the real estate side.
The other big factor is regulatory bodies. So you'll have, I can't believe I'm drawing a blank on the name. So you'll have CMS will come and do surveys twice a year in skilled nursing. There's some of that in assisted living, and there's ways that they have to check in, but it's not to the extent or to the depth or detail that like CMS will come in and look at skilled nursing facilities. And it's all because it's Medicare, Medicaid, government reimbursement, right? So there's much more. It's actually similar to banks, to be honest. There's a ton of regulatory overhead or oversight in skilled nursing, not as much in the senior housing world.
Interesting. And how would you say the industry is delineated, meaning that is it a very high barrier to entry on the higher acuity side, where there's just so many regulatory things that you're probably not going to see any kind of ma-pa situation on that, versus over here it's probably more developer-ish type of mentality? Or
that's 100% true. So there used to be a lot of skilled nursing facilities that were kind of mom and pop operated, or this is what I've gathered. I've only done that for a couple of years, but where it really was kind of this mom and pop, let's deliver awesome care, but it's just, you can't make money doing that with some of the rules and requirements and this regulation that's put. So right now, a lot of the acquisitions or in-market activity are these mom and pops that are saying, I can't keep up with what they're requiring for me to report to get my reimbursement rate. And there was a big shift this time last year to a new kind of reporting or coding way to get their reimbursement from Medicare or Medicaid. And so a lot of those mom and pops are selling to establish kind of corporate style, let's call it 5 to 100 property operators. So yeah, that's where most of the activity is right now. I would say I think that sums up probably the big difference.
That's good. And then what do you guys look at when you're, obviously, you talk about EBITDA versus NOI. Are there some key things that you guys are kind of putting your finger on every time you're looking at them to sort of get a rub as to if this is going to work or not, or things that you're keeping a keen eye on?
Yeah. And I'll probably start a little higher level because there's so much financing or financing solutions for these operators currently available. So you have Freddie and Fannie or HUD that can take for long-term financing, 20 to 35 years, non-recourse, really cheap debt. It's expensive on the front end, hard to get approved and funded. So then you have kind of what I would say banks, which commercial banks where BOKF would fall in, where we're looking for existing cash flow, not a turnaround deal. Because there's a lot of these properties that have negative cash flow and people buy them for the upside to turn around operations. Unless there's a big corporate company behind that where we've seen a track record in their ability to right size these properties, and they can also provide a guarantee that we can underwrite to, right, the existing cash flow in place. We can, facilitate transactions on the turnaround basis in that scenario. But a lot of times operators are trying to keep these, packages onto one asset. And so they don't want to tie up a bunch of existing asset or cash flow. So where we fall in and what we look for is several years of existing cash flow. We do not work with many operators that have less than 5 properties. It's a fundamental belief for us that we like to see existing properties that are stabilized, that if something were to go wrong with what we're financing, the ownership has resources to pull from to keep investing into that asset to make sure it stays afloat. The risk you run with the performance on these can turn overnight based off census or rent roll. And so it's a higher, I would say, risk class, which is why they're getting higher yields, right, as an investor. And so tying multiple aspects of cash flow to make sure that we're in a secure position, that's really important to us. We love working with regional operators, not national operators. We think it's really, healthcare is best delivered kind of on a regional basis. It's so personal. So that's something that we look for and key in on. And then as far as ratios go, debt service on a fixed charge, or debt service on a SNF, we're going to look at 135. That's fully loaded. That's the debt service. I'm sorry. The debt service on the SNF is 135 is where we typically set our threshold. Fixed charge of a 1.1. That's fully loaded with kind of an assumed CapEx and distributions. Senior housing is a little bit lighter. We still try to push for at least a 130 coverage ratio. In skilled nursing, as far as leverage goes, we don't like going above 80% loan to value or loan to cost. Most of these are valued on a 13 cap. So if you back all that in, it comes to about 6.5 times leverage on adjusted EBITDA is kind of the top of our house, right? On senior housing, the leverage point is a lot higher. So speaking in debt yields, and I would have to go back to we're kind of comfortable at 10% debt yield, but that's the full bottom for us. We want to see 12% or higher.
So on the debt, let me have you maybe flush out some of those ratios a little bit. So when I say debt yield, what you're saying there is you're taking the net operating income, correct? And then you are and then you're basically dividing that by the debt. Is that correct?
That's correct. Yep. And we typically look at when that 10% would be total. So that's not senior, junior, that's senior and junior. We don't, because at some point these all right size. And we make, and when I show my really kind of high level cash flow model, we always adjust for a 5% management fee because that's how they're appraised, right? So if they take more or less, we kind of adjust to it. So that's how we level set, David, is we get to that debt yield and kind of know our buckets. I would say this industry heavily negotiates recourse. And so based off of debt yield is typically how we set recourse. Full recourse, maybe something full with a burn off or burn down and then full with a burn off. And our trigger point is typically debt yield.
So when you, would you say the majority of them, 75% are going to fall into a full recourse category, or would you say it's half and half, or do you typically just doing a burn off once they hit certain particular hurdles?
It depends on, for BOKF, we hold recourse near and dear to our heart. I can't think of many transactions we do without some level of recourse. I would say in the industry, there are banks who will do more non-recourse. You're going to pay a little bit more for it, not a ton more, but you'll pay more for it. And I would say, 100% of the deals have some form of burn down that I've worked on.
Yeah, that makes sense.
Yeah.
And then when you talk about the ratio on the EBITDA, so you're taking the earnings before interest, taxes, depreciation, amortization, and rent, essentially, and then you're dividing that number by the debt amount. Is that correct?
Yep. It's the inverse. So it's funny how it's literally the same thing, but both segments view it differently, and that's how you'll see the proposals.
And then when you talk about fixed charge coverage, walk us through that a little bit as to how you.
So the example I have that we'll walk through, I won't spend as much detail. I did a senior housing example, so I'm using NOI, so I'll just stick with that. So start with net income, then you add back interest, depreciation, amortization. You get to your true NOI. Then you add back the actual management fee. You divide, then you subtract out the 5% of revenue assumed management fee to get to what we call an adjusted NOI, or that's like an appraisal NOI almost. And then you divide that. Then for total debt service, you take obviously principal and interest, and I add in a maintenance CapEx. So if depends on the vintage of the property and the condition of it, but our standard is $300 per unit. So if you have a 62 unit property, you're going to use this $300 per unit. It gets you to 18,000 and kind of what we would consider fixed charge. So you have your adjusted NOI, and then you have your debt service plus fixed charge, and you divide that to kind of get to your and then distributions. Any distributions would hit the denominator on the fixed charge as well. And then you get to kind of your, 1.1 or 1.0, depending on the, other aspects of the deal.
And you need to be at a 135, correct?
So the 135 is pre-distribution. Yeah.
Okay.
And then, yeah.
Post-distribution, be at close to break even or
closer to 1. Okay. Yeah.
And are you typically underwriting this off of tax returns? Do you take P&Ls? Do you take audited financials? What do you need?
Yeah, because unless you have a big corporate entity that everything rolls up, you won't see audited or CPA compiled or reviewed statements very much because they're really standalone assets. So by and large, the financial statements will analyze our P&L and balance sheets from just kind of pull like QuickBooks or whatever accounting software they have. So if I were to get a new opportunity, I would ask for 3 years of financial statements, the most recent interim and prior, so I could get to a TTM calculation, rent rolls for all those corresponding periods, and then that's really all you need for property specific. Then you have, the corporate entity, the guarantor, and all that other stuff. But that's the core of, okay, this is the asset we're financing. What do we need to assess our position? If there's clear deterioration over that period, and then in the TTM, they're showing an upswing, monthly financial statements are a must. So you can kind of see what's driving it. Do they cut nursing expense or personnel expense, and occupancy is still staying flat? Because there's only so long you can do that, right? So you want to see what's driving the rebound in NOI. And if it's occupancy driven or if it's expense reduction, oftentimes it's both, right? But then you can start asking questions on, okay, hey, where do you need to be on a staffing level from a regulatory standpoint and a profitability standpoint? What's your break-even occupancy? Like, when are you making good money? Then you can kind of dive into, there's lots of resources out there. They cost some money to look at market analysis and kind of compare the trends. Like, did a new property come open and there's 200 extra units within 3 miles that really kind of hit that? And you can kind of assess the long-term impact of what's going on. So that is what you see a lot, because people are buying properties for the future, for the upside. And so you have to really dive into, okay, what did this look like 3 years ago? What happened in the interim? And then do we think it's sustainable to justify their projections?
Okay. And so you're looking at those ratios, which I don't know if you have something you want to pop on the screen at all, but and I think I might have given you access to the share screen on there. Is that on there?
You did, yeah. So I'm gonna, here we go, share screen 1. Okay, let me know if that worked.
Yep, it did.
Okay, so this is very bare bones. I just threw it together. Dave, we jumped off the phone. I can provide much more detail, and maybe even, it depends on if you guys are really looking at the skilled nursing industry or mainly senior housing, let me know and I can help kind of navigate the conversation which way. But this would be, I just picked let's call it a 62 unit assisted living facility, and I made all these numbers up. we're saying 400 in net income plus 100,000 in interest expense plus depreciation. So I got to 645 in NOI. I said they took a management fee of 109, but 5% of their total revenue, and I just made up their total revenue of 2.35 million, is actually 617. So we would hit them for that, right? Because the industry would say most operators are going to take a 5% management fee, and that's how properties are also appraised. So no matter what, if they take more or less, you typically back that down to 5%. So I used on my calculation adjusted NOI as kind of the baseline for both debt service and a debt yield. My debt service, I just said 450. I just pulled that out of thin air. CapEx is 300. I wonder if I can zoom in on this. Sorry, guys. 300 times the 62 units. And so my debt service coverage ratio is NOI divided by debt service plus assumed CapEx. I didn't put distributions in here because you can solve for that, right? And whatever that is, you plug it in. So in this example, the debt yield would be at 12.73%. So we're taking that adjusted NOI for a 5% management fee divided by the total debt of 5 million. So that's, and based off of these two figures specifically, is how I would assess my next steps. Is it something that I can understand? Do I need to go back and get monthly statements now because, hey, I want to justify this, but the last 12 months, you know, this would be a pretty tight deal, candidly, right? So we're going to look for outside support from either a guarantor or other facilities, or just a really logical and rational story as to why the last 12 months have produced these two figures.
That's good. And so you have to have existing cash flow, historical cash flow. It has to be a seasoned operator with at least 5 facilities. You are collecting all these appropriate documents. So once you get over this hurdle of assessing it, now, does it have to be, do the ratios have to be consistent throughout the years? Meaning that if you have a 140, does it have to be that way every year, or what? How do you look at that?
Yeah, I mean, preferably it makes my job a little easier, right, to justify but that's just not the reality of the industry. There's big swings quarter over quarter, whether it's, you know, it's primarily driven in senior housing by occupancy and competition. In skilled nursing, it can be really complicated because some states get paid based off of the cost they do for the cost of care. And so if your cost report is every 2 years, and so you could spend, it can just jack with your reimbursement rate. So sometimes the ratios look really crazy. And you're like, hey, yeah, well, we put our costs, we came in as a new operator, we drove our costs way down because we're more efficient than the prior owner. The state came in and looked at our cost report, and now our income or revenue per patient day revenue went down. And so you'll see a margin compression and kind of a correction of that. So skilled nursing is pretty difficult to assess without having some detailed conversations with the operator of like what's going on. Senior housing is a little bit easier to figure out.
Yeah. So if you look at the landscape of, you know, all the way from, you know, skilled, memory care, along that band, what's sort of the, I guess, you know, underwriting or buzzwords that people kind of focus on when they're looking? Obviously, is there particular from the operator's perspective, the ratios they focus on, or the things that they look for, and, you know, in buying these facilities or operating them?
Yeah, so that's a good question. It's hard for me sometimes to sit on the other side of the table from the operator's standpoint. Senior housing, historically, those owners and operators enjoy leverage more than skilled nursing. So they're going to look for lower debt yields, the thresholds, kind of cash out, tend to have less of an understand. If they come to me with a 6 month annualized NOI that supports the debt level, they're like, well, let's do it. It's easy. We've done it for the last 6 months. Well, in reality, it's not the case. So I think the time horizon for the owner operators and just the financing market, I think there's a shorter window of we want to see consistent cash flows in the senior housing versus skilled nursing. So that's one thing I think a lot of packages I would see or conversations I would have with the operators as well. Look at my trailing 3 month, it works there. And it's like, well, yeah, 3 months don't make a trend. So that's something to consider, is understanding what the last 12 months or last couple of years, 12 months, 6 months, 3 months look like. And then, yeah, leverage, I think, is trying to fit in. There's financing solutions for all the deals I just talked about. They're going to pay more for it, but there's lots of bridge to HUD or bridge to Fannie or agency platforms out there that they'll charge you, LIBOR plus 8%, and they'll put on debt at, 8% debt yield that's on a trailing 3 month at a 1-to-1, and because their risk tolerance is a little bit higher. And the whole goal there is within 24 months to prove up NOI to shift it to HUD or Freddie or Fannie. So there's borrowers who do that, not commercial banks for the most part.
Does every asset category qualify for a, Freddie, Fannie, HUD type of situation or not?
I am not an expert, and there's a lot of caveats. So typically you'll see skilled nursing be refinanced with HUD. HUD actually finances, one of the more recent loans I closed this summer was for residential memory care facilities, and they were scattered site. So they weren't adjoined. They're all different, but there was scale to it. So there was 7 properties. And so we bundled them together. I did the bridge part. I had crazy cash flow for the last 3 years. It just worked out from a bunch. Debt yield was super high. It was just a good deal. And that's going to go through HUD. So that's in the HUD application process. Fannie, Freddie are typically, actually life cos are really active in the space too. Not so much since the pandemic hit. They're a little more, and the offset with life co versus Fannie, Freddie is advance rate. They'll come in at 65%, whereas Freddie, Fannie will come in 75, 80%. So
doesn't surprise me. And then what are you seeing from like a terms perspective on your side of the equation? How do you structure those?
It depends on the borrower. You have some borrowers who like commercial debt. Then you have some borrowers that they want to get it to agency or HUD as soon as possible. I would say the vast majority of our deals fall 3, 5, or 7 year. We do not go above 7 years. Most banks won't go above 7 years. It's pretty rare that they will. 5 years seems like it's the most common for whatever reason, for kind of long-term commercial debt on these properties. It's a cost thing too. The cost of capital is better. Odds are they're going to recapitalize it within that 5 years anyways.
Oh.
So
is it usually on a 25 ammo, or what's the schedule?
So that's something that we compete. It's a tough competition point for us. We stick to our guns on a 25-year AM, 20 on SNF, 25 on senior housing properties. There's a lot of people who will stick, go out to 30 depending on the year. And we have occasionally, if it's like a brand new building, but typically we're 25 and 20. And pricing historically has been floating and swapped or just floating. And we typically will put some type of exit fee or prepay, even if it's floating, we'll put like a 24, 18 months just so we can actually receive the benefit of that net interest revenue. Because it takes a lot of time to get these done and it's expensive with the third parties. So I would say the industry generally likes to keep their assets pretty flexible and not locked in.
Interesting. And then what's typical? So somebody brings you a package. What's the typical process for you guys internally from soup to nuts?
So once I get a full credit package, I'll kind of do, I'll get an underwriter involved. have them do the heavy lifting on the spreads and kind of initial analysis. We'll put together what we call an opportunity memo. That can take, depending on the complexity, let's say 3 to 7 business days typically. Get that to our credit team, have conversations, issue a term sheet. That whole process, I like to say, I like to aim for less than 10 business days as my personal goal. Lately, it seems like it's taking more time. Just banks are busy with whether it's PPP or just trying to understand or what the impact of the pandemic is going to be. So we're a little slower right now. I think most banks are in the space, but that's what I shoot for. If we get the signed term sheet back, we order I feel very confident to close within 60 days from a signed term sheet. 45 is doable. That's pushing it a little bit right now because appraisers, phase ones, and property condition reports take a little bit longer because people are not as willing to step on property, especially this is a highly susceptible population to the pandemic, right? So you have to remember that the policies and procedures are drastically different today than they were, 12 months ago. So there's some more time on that end, but from signed term sheet to closing should not take more. And that includes, full underwriting approval, loan documentation, appraisals, zoning, survey, 60 days.
That's great. Yeah, that's been really, really helpful. So thank you for walking us through that because it's a little bit of a niche and unique industry. So we're
I more than willing to, have follow-up. I am not like the end-all be-all expert. Our bank has a ton of resources. The bank has been doing this for 25 years. So there's some people at BOK that really know this stuff. So if you guys have some follow-up questions, let me know and I'll get someone pulled in. I would say from your perspective, if you're trying to find deals and place them with financial institutions, there's just a ton of deal volume, right? And so we see a lot of our deals actually came through relationships like this. And so there's definitely a segment for it. It's a very small world. In my 2 years, it's crazy, the overlapping from the operator side and the financing side. But it's very active, very active.
Yeah, so you bump into a lot of people, I'm sure, or see the package twice. So.
From different, seriously.
I know that world.
Yeah.
Well, thanks a lot for helping us, and I know it'll be helpful for Dan as well. So
thank you.
And we'll land the plane and regroup next week, you and me.
Sounds good.
All right. Thanks, brother. Hope you're doing well.
You too. See you.